All right, so following the Fed is not a great spectator sport like watching the NBA Finals or seeing motorcycles jump off ramps, but their decisions affect your interest rate, which is your cost of money. The Federal Open Market Committee has 12 members and they manage the U.S. money supply. They want economic growth and stable prices. Now, why would the Fed raise interest rates on you? To cool an overheating economy, which helps slow inflation. Now, just think about it. If interest rates were high, like 15%, how motivated would you be to borrow to launch or expand a business or borrow to buy an income property? Not so likely because that's a high interest rate. You'll hear the term rate hike a lot. It just means an interest rate raise. I wish they'd just say raise. Why exactly does the Fed raise interest rates to combat high inflation anyway? That is because high inflation makes consumers lose faith in currency, and high inflation also means variable inflation, and then that makes it difficult for people and businesses to plan. Now, oppositely, why would the Fed lower interest rates? To stimulate a sluggish economy. See, if rates are low, like 3%, well, now you'd have an incentive to open a business or buy property with a mortgage. You will stimulate economic activity. You'll see the media use terms like hawkish and dovish to describe the Fed's temperament as well. Now, a hawkish stance, that just means that the Fed is guarding against high inflation. Therefore, a hawkish Fed would quickly raise rates to put the brakes on inflation. A dovish stance means the opposite. They don't take aggressive action when they signal that they're not going to change rates. That's a dovish tone. The Fed has 8 regularly scheduled meetings each year, and this is where they announce if there is going to be an interest rate change, and it's usually a quarter point at a time that they make those changes. Financial markets watch these meetings closely. The president nominates the Fed chairperson for a 4-year term, and then the president and the Fed chair are supposed to be independent from each other. This means that sitting presidents should not make suggestions about the Fed's direction, but some have. Donald Trump has made remarks to current Fed Chair Jerome Powell to chill with the interest rate raises. You see, presidents don't want to see the economy be slowed during their term. They want lower rates so that economic activity is stimulated under their watch. Well, there's way more to the Fed. This is just a quick, keep it simple overview. Although the play-by-play is about as interesting as watching your neighbor whack weeds, know that the Fed affects your cost of money. My name's Keith Weinhold. If you like innovative wealth building ideas, including how I clearly explain how you can profit from inflation and create financial freedom in your life, listen to my free weekly Get Rich Education podcast. It's as easy as downloading the Get Rich Education app. I hope you're having a great day.